Good morning, class. This is going to serve as your 20.2 lecture, and we're going to finish up talking about financial statements and their preparation and accounting and financial reporting. And we kind of started off this with talking about the balance sheet, and we talked about assets, liabilities, and owner's equity. And we kind of went into a lot of detail over the week. We did, I would say, a good amount of work to get us a feel for it, and then I had you put in a template, and I completely get that some of the numbers we put into our templates don't have a lot of meaning. And that's honestly okay at this point. At this point, we're kind of just touching over the surface as we go through entrepreneurship. And we're diving a little bit deeper than we might have done in a principles class, but we're not taking it to an accounting level type preparation. And that's honestly where we should be. What we're doing is where we should be. We shouldn't be going as deep as accounting. So we're going to finish up this chapter by talking about the income statement. And we have some other objectives as well. We're going to describe some of the information included on each financial statement, identify ongoing accounting activities, and talk a little bit about how technology kind of helps us tie it all together. So the good thing is, we talked about the balance sheet already, and that is by far probably the harder of the two statements that we learn. Income statement is a little bit more straightforward, and we'll see that in a little bit. So the heart of the matter is that financial statements are critical for businesses to understand what is going on in their business. And it's critical that they're accurate, up to date, and they show you the health of your company and where it stands. And to me, what's really interesting and critical about financial statements is that it gives you the opportunity to potentially buy other businesses. And that might be shares of stock, or that might be ownership in a piece of place in a town. Both are just various opportunities for you to make money as you get older. And that's what I always enjoyed about it. So you're going to see, but we use financial statements to actually create a price for a business. And once we have that price, we can then say whether or not the deal we have is a good deal or a bad deal. But we'll talk about that in a bit. So this is your vocab, and obviously awesome. It's a little bit shorter than what was before, and one of the words is balance sheet, and you guys probably know that. So there are three types of financial statements, and they're needed to operate a business profitably, and you got to stay up to date. Kind of all obvious information mentioned before. And the types of financial statements that exist are income statement, balance sheet, and statement of cash flows. These are the three primary ones. We're taking this class and just focusing on two of them. The balance sheet, which we learned about, which is assets equals liabilities plus owner's equity. Today we're going to learn about the income statement, and last we'll touch on the statement of cash flows, but we won't work into it as much. So I'm going to let Khan Academy take over and talk about the income statement.
I figure now is as good a time as any to learn about probably what most people focus the most on when they analyze companies, and that's the income statement. And the income statement is one of the three financial statements that you'll look at when you look at a company. There's the income statement, and the other two are the balance sheet, which I have drawn a lot in a lot of the other explanations I've done on the financial crisis and whatever else. And actually in this video we're going to see how the income statement relates to the balance sheet. And of course the last one, well, it's not of course if you don't know it, is the cash flow statement. Cash flow statement. Cash flow statement. And we'll focus on that a little bit later because that's a little bit more nuanced relative to the income statement. So the income statement is literally just saying how much a company might earn in a given period, and it always was related to a period. So it would be, it could be an annual income statement, it could be for the year 2008, it could be a quarterly income statement. Those are usually the two types you see, but sometimes even there's monthly or 6-month income statements. And the general format is pretty consistent, although there is a lot of variation depending on what a business does. But in this video, I really just want to cover almost a plain vanilla income statement for a company that just sells a widget. So the first thing when you sell a widget is, you make it and you just sell it, right? You sell the widget. You give a customer a widget and they give you some money, right? And that money that they give you, and I'm not going to get too technical about the accounting right now, is considered revenue. Revenue. It's sometimes considered sales. And that's literally the money that they give you in a certain period of time. And some of you accountants out there is like, oh, well, no, that's not just the money that they give you. It's the money that you've earned in a certain period of time. And that's true. But for our sake, let's just say that when you give the widget, you have earned the money that they give you, and that's revenue sales. Later on, we'll talk about different ways to account revenue and sales. So let's say the revenue or the sales in this case in a given period, let's say that this is the income statement for 2008. So over 2008, we sold, I don't know, let's say $3 million worth of widgets. Let me do same color. So let's say it's $3 million. And a lot of times when you look at income statements for companies, if you go to Yahoo Finance, you could do this right now. Instead of writing 3 million, you'll see 3,000 there. It's like, oh my God, this company, they're hardly selling anything. But it's kind of a standard is that they tend to write things in thousands. So 3,000 would be 3,000 thousands, which would be 3 million. And for really big companies, they actually sometimes write their numbers in millions. So if you saw 3,000 there, it would actually mean 3 billion. But we'll actually look at real income statements in the not too far off future. So that's how much money they give us. But that's not how much income we made, because there was a lot of costs that went into making that widget that we have to account for. It's not like when someone gives me $3 million, I can just say, oh, I made $3 million, let me just put it all in the bank, I'm done, that was all income. So the first thing that you tend to see on an income statement is the cost of those actual widgets, the cost of producing those widgets, and those and I'll put all my expenses in, let's do it in magenta. So it'll sometimes be written as cost of sales, cost of goods sold. And this is literally, well, there's two things. There's a variable cost, which is each widget, they might have used some amount of metal and some amount of energy to produce it, and some amount of paint if it's a painted widget. And so the cost of goods is literally how much did it cost to buy the metal and the paint and provide the electricity to make those $3 million worth of widgets. And then that's the variable cost. And then on top of that, you have the fixed cost, or the relatively fixed cost, where just to have the factory open, it costs a certain amount of money every year, regardless of how many widgets you make. And we'll go into more detail on that. But for simplicity, let's say all of those costs of making the widgets were $1 million. So sometimes someone might say it's a $1 million cost. I like to, when I make models, I like to put a minus there so that I remember that that's a cost. Anything that detracts from income, I put as a minus. Anything that adds is a plus, although that's not necessarily the standard convention. Some people say, oh, it's a positive $1 million cost, which means you subtract. But either way, I think you get the point. And then if you subtract your costs from your revenue, or if you just add these two numbers, because this one is negative, you have your gross profit. Gross profit. And in this case, it would be $2 million. $2 million. And this number tells you how much money did you make, or how much profit did you make just from selling these widgets. So the more widgets you sell in most circumstances, the larger this number is going to be. So this is your profit before all of the other expenses that a company has to incur, like the taxes and the CEO's salary, right? The CEO's salary doesn't go in here, right? Because the cost of making a widget the CEO doesn't go out there into the factory in most cases and actually help make the widget. So the CEO's salary or the CFO's salary or the headquarters in a nice skyscraper, that doesn't get factored in here. Or the marketing expense, right? You have to tell people, hey, we make good widgets. So none of that is factored in here. So that goes into the next line, and oftentimes you'll see it broken up where it's, they'll have marketing expense, Sometimes they'll have, sometimes you have to pay salespeople, so you might have sales expense, and then the stuff like the corporate office and the CEO's salary, and you have to hire auditors and accountants and all of that. That might be included as general. Actually, I should be doing this in magenta because it's all expenses, marketing, sales, And then G&A, you'll sometimes see. Sometimes you'll see SG&A. G&A just stands for General and Administrative Expenses. If you see SG&A, sometimes instead of that you see SG&A. That means Selling, General, and Administrative Expenses. Selling is things like, it could be the commissions that the salespeople get. It could be just the cost of having salespeople travel around the country and taking people out to steak dinners. And then the general and administrative, that's just all the stuff that the corporate office does and all of the people who are at that level. So if you subtract these, and I'm just making up these numbers as I go, say marketing, the company is spending, I don't know, say it's $500,000. And I'm putting it as a minus because I like to remember it's an expense. Some models you'll see, they'll just write it, they'll say it's $500,000 expense. Sales, let's say this is just G&A here. I want to make a separate line for sales. So let's say sales, selling expenses is $200,000. And let's say G&A, the corporate offices and all of that, let's say that's another $300,000. $300,000. And now we're ready to figure out how much money did the operations of this business make. So this is operating profit. Operating profit. And this is really important to pay attention to because so many people say, oh, a company made this much, and you'll hear these numbers gross and operating profit and net profit and pre-tax profit. And it's very hard to understand that these are actually very, very different things because they all have the word in profit and, what does gross and operating and all of that mean? But here you see it means very, very different things. And let's calculate this number first before I go off on one of my tangents on all the differences between the operating and the gross profit. But let's see, 2 million minus, let's see, 1 million. My head, I think, implicitly made the numbers work out nicely. So my operating profit here is $1 million. So already we have some nuance on profit. I made $2 million just from actual widget sales, but then when you take out all of the overhead of the company, the marketing, the sales, the general and administrative expenses, I'm only left with $1 million. And this is the profit from the operations of the company, or you could say from the assets or from the business or from the enterprise of the company. That's what is generating. But we can see, I've drawn a bunch of balance sheets before, and I think this is a good time to draw a balance sheet. So you have kind of the assets of a company. And we'll talk a little bit more about assets and enterprise value, and there's a little bit of a nuance there. But essentially the company itself, before you think about how the company is paid for or how it's funded, if you just think about the enterprise itself, the assets are generating this, right? They're generating the operating profit. And that's a very important thing to realize in the future when we talk about return on asset. Actually, we could talk about it now. If let's say our assets, if we paid, let's say $10 million for these assets, and these assets, this is the income statement for 2008, are spitting out $1 million a year, or at least $1 million in this year. Our return on asset, I wasn't planning on introducing this, but it doesn't hurt to introduce it right now. Our return on asset, often acronymed ROA, return on asset, would be, well, the numerator is the return, which is $1 million. 1 million. The denominator is the assets, 10 million. So we got a 10% return on our assets, right? For $10 million investment, we're getting $1 million a year. We're getting 10% of our asset investment back every year. So that's a nice thing to keep in the back of your mind, this return on asset concept. And it's very closely tied to operating profit and the actual assets of a firm. What we've learned, and especially if you watch some of my other economics videos, that all companies aren't financed the same. A lot of them might have some debt. So let's say that company had $10 million of assets, but let's say they paid for it with $5 million of debt. $5 million of debt. And let's say the interest rate on that debt is, I don't know, maybe think of a good number. Let's say the interest rate on that debt is 5%. So let me make it, let's make it 5%. I don't make it easier now. Let me make it 10% interest, right? So this is their operating profit. This is the money that just comes out of the asset itself. But of course, that's not the money that we get to take home because we have to pay this interest. So let's throw that in there as an expense. Interest expense. And obviously a company that has no debt will have no interest expense. But in this case we do, and this is an annual income statement. So let's see, we have $5 million of debt, and we're paying 10% on that. 10% of $5 million is $500,000 a year in interest. So we have to essentially take half of our operating profit and give it back to the bank. And now we are left with we're getting close to where we need to get to. We're left with our pre-tax income. Pre-tax income. And if we do the subtraction, we're at $500,000. $500,000. And you could guess what the next line is going to be, given that this says pre-tax. This is what the owners of the company get before they pay the government. Right? So you could guess what the next line is. It's going to be taxes. Taxes. Let's say that it's a 30% corporate tax rate. So 30%, and you're going to take 30% of this number right here. 30% of that number right there. So 30% of 500,000 is $150,000. $150,000. And then we are done. We finally have paid off everybody we need to pay off. So we started off with $3 million up here. We kept paying a bunch of expenses. And then now we're left with what? This is $350,000. $350,000 of net income. Net income. And this is what goes to the owners of the company. This net income right here. So going back to our balance sheet, we had a $10 million asset. We had $5 million of debt. We know what's left over is the equity. So let me do that in a vibrant color. Equity is what's left over. So let's say this is all book value. So we have $5 million of equity. And when I say book value, that's just a fancy way of saying this is what our accountants say that we paid for the stuff. This is what we have on our books. And we'll talk later about depreciation and amortization and how we might change what these values are. But a very simple way is if you went out and bought $10 million worth of stuff, you'd write on your books, I have a $10 million asset. And if you took a $5 million loan, then what you really own, if you were to kind of sell all of this, you would get $5 million of equity. Of equity. And now this is an interesting thing. When we did return on asset, we looked at the operating profit because this is what our company generated before we paid the bank or Uncle Sam or anything like that. And so we took this number as a numerator and we divided by the number of assets. Now we can do another notion, and that's return on equity. Return on equity. So return on equity. And return on equity, the numerator is the net income that we got. So it's $350,000. And the denominator here is the equity, the book value of our equity. So that's $5 million. 1, 2, 3, 1, 2, 3. Let's cancel some zeros out. So it's like 35 over 500. 35 over 500 is the same thing as 7 over 100. So it equals 7% return on equity. And that's interesting because, well, why that's lower is I don't want to go too much depth just because I realize I'm already pushing my time limits. But at this point, you should have a good understanding of at least a basic income statement of of kind of a company that sells widgets. And in the future, we're going to look at a lot of different companies, financial companies, insurance companies, natural gas pipeline companies that will have very different looking income statements. But this gives you the general template for how things work. And at least will give you a sense of how revenues, gross profit, operating profit, pre-tax income, and net income really are different. And it's, a lot of times in the popular press, they're all jumbled up as just kind of the company's making this much money. Anyway, I'll see you in the next video.
All right, pretty good video. And I like how he starts to go into financial ratios, which is not something we address in this class, but it is something talked in the accounting class as well. So your income statement, and here's your formal definition. It's a report of the revenue, expenses, and the net income or loss for the given accounting period. And I know we still have that sheet on our notes that kind of compares the income statement and balance sheet. Here's one thing to notate. The income statement covers a lengthy period of time, whereas the balance sheet covers one point in time. So an income statement could cover a year, it could cover a month, or it could cover a quarter. All of those are relevant time frames. Sorry if you hear my dog in the background. So here is a 3-year income statement and a balance sheet. The income statement is up top, And you're seeing this company's sales go from 144 million in 2009 to 150 million in 2011. And then it goes into their cost of goods and their gross profit. And we'll kind of review these in a second. Operating expenses are those expenses that it takes to get this gross profit. And then we have income from operations, and here it is. And so one thing you see with this company is that even though they're now doing $5.5 million more dollars of business, they've actually lost $1.2 million in income from operations. So that is oftentimes a rough pill to swallow for a company. In order to grow, they're losing money to the bottom line. So we have other expenses and losses here, and then income before taxes, and then our income tax, and this is our net income for the year. And you can see it actually dipped quite a bit in 2010, and then it went back up. And then we have earnings per share, which is kind of interesting because what they're doing is they're taking all of this income and they're allocating it equally per share. So C corporations do this, and depending on how many shares you own, the company may issue a dividend based on this number. So a company is not going to give away all of this money based on shares, but they might say give away 20 cents or 25 cents. They're going to give some of it back to the owners of the company because that is legitimately the point of a company. Nice thing here is that this ties back together with a balance sheet for Pinnacle Manufacturing. We're not going to go into too much detail. I don't want to go backwards and waste too much time, but we can revisit that at another point in time. Here is your basic equation for the income statement. Revenue minus expenses equals profit or loss, and plenty of companies lose money. They don't lose money forever, though. Eventually, you'll run out of money that you'd had earned from prior years, and owners either have to reinvest or the company has to go out of business. So the last statement we're going to talk about is the cash flow statement. And this is the amount of cash available to a business at any given time. And this is really the cash flow statement, just tells you how cash moves through a company. And the thing with cash is king, obviously. Cash allows you to pay bills, and that is why cash is always critical. So here's an example of a cash flow, and it starts out with net income, and it adds depreciation, and it follows through this pattern. And you don't really need to understand this pattern, just understand that this statement of cash flow follows cash and how it changes in your company over a period of time. So what they're saying is the cash available for this company at the end of the year is $2,200. All right, so these are some notes that I want you to write down, and we're going to go over them as we go along. And I have 2 pages of this, but I absolutely want you to know this so this can make it on to your note card. Revenue is what the company does. It's also called sales. And cash received for selling goods or providing a service is what a company earns, and that's called revenue. Your cost of goods sold, otherwise known as COGS, is the cost of the goods that the company sells. So we call that what it either makes to produce something or potentially the cost of reselling something. So your inventory and the expenses associated with that inventory, cost of goods sold. Your gross profit is the difference between revenue and your cost of goods sold. So you would take your revenue that came in, you would subtract your cost of goods sold, and I'll show you this on the next slide, and you would have your gross profit. One easy way to remember gross profit or net profit, the difference, gross profit, gross anything will always come before net because G is before N in the alphabet. That's how I always remembered it as a student. After gross profit, we get hit with operating expenses, and those expenses are the costs that occur to the business. If we total those up, we'll have total operating expenses. The sum of all operating expenses occurred during the period of the financial statement. Then we'll go into other expenses and other revenue. Those are expenses and revenue not associated with regular business. An example might be interest on a loan. So if you need to pause it, yell, and we'll pause it. I'm going to keep going for the sake of reading and making this video too long. All right. Net income or net loss occurs when expenses are removed from gross profit. So, like I said earlier, businesses can make money, they can also lose money. This is kind of how it looks over here. And this is what I would make sure you definitely have this down. So you take your revenue and then you'll subtract your cost of goods sold. You'll get your gross profit. From your gross profit, you'll subtract your expenses and you'll have net income before taxes. Your taxes are 20%. We'll subtract those out and have a net income after taxes. And we'll do some examples and we're going to play around with this in Excel a little bit so you'll get to see it there. Okay. Stop now if you need to stop so we can get all this, and I'll keep going shortly. All right, last definition. Statement of cash flows. How much cash a business took in and where the cash went. And that is the simplest, best way to put it. And I'm not sure how my slides got out of order, but they did. So these are some ongoing accounting activities, and we kind of talked to them at the beginning of the section, but you post to your general ledger, you keep track of all payments, you keep payroll records, right? Because you have to pay people. And then your weekly activities are keeping tax records and then just filing everything. Everything gets kept, and computers allow us to file digitally and electronically, and we can pull information up through various accounting systems. I think there's one or two more slides left. We're getting to the end. All right, preparing financial statements, always ongoing, paying payroll and tax deposits, and reconciling bank statements. All of those things are something accountants do on a regular basis, pretty much nonstop. Reconciling bank statements is something we used to do as a society. We used to make sure that the money that we said was coming out of our checking accounts matched up with what the bank said was in there. That's a little bit, it's not really necessary anymore, although I do know some people that do it. So, and then monthly accounting activities, replenish petty cash fund, and balancing the checkbook. Both of these are becoming less and less relevant as technology takes over what we do. We don't really need to balance our checkbook and reconcile with our bank statements anymore because, and I haven't heard of anyone having a bank issue in a very long time. And then petty cash funds are almost non-existent now. Businesses used to have small cash funds that would be used for things like buying drinks for everybody, or buying lunch for everybody once in a while, or an emergency fund to go out and get supplies real quick. Most companies, instead of a petty cash fund, are just using a company credit card, and then they'll just pay the credit card off at the end of the month. So, using technology, recording, summarizing, and reporting financial information can be a time-consuming activity. Computers offer small businesses the ability to automate accounting functions. I think that's kind of what we all expected to hear. And yeah, the way a computer system works with an accounting, it takes a lot of the tediousness away from actually doing the accounting. That's it. That's all she wrote. I hope that was not too painful. I think this is a great chapter. It's a great section to learn about. And I hope someone actually jumps into it one of these days. So that's all I got. This is a little bit long-winded, but we'll talk to you next time.